Hello, hello. Gonna wait a few minutes for people to join. We'll get started. If you can see this, do me a favor and just give me a thumbs up or some sort of visual confirmation that you can hear the actual stream here. That'd be great. Sweet. All right. Thank you. We're going to wait about 2 minutes and we'll go ahead and start. Appreciate you guys taking time out of your week to let me rant at you for the next 30 to 40 minutes. This won't be the longest webinar, but that's okay. This might be my favorite one, though, out of everything that I've gone through over the last few weeks. Try to spread out the topics, some higher level stuff, some more easier stuff. Obviously, I've been in the market now for going on 15 years in February of next year, so coming up. 15 years of staring at charts. It's pretty wild to think about. So I would prefer to talk a little bit higher level stuff. And in this case, it's actually going to be not higher level stuff. It's going to be a very simple concept that hopefully will make sense to you. I'm going to prove it to you the best way I can statistically that it makes sense. I'm going to show you how it works. I'm going to give you some examples that we are currently in right now utilizing the tactic to get long. And hopefully you guys can introduce it to your trading system if you're not currently using something like this. My favorite part about this, I didn't make it up. As a matter of fact, every single component of the TTI Trading System was taken from inspiration somewhere else. I'm classically trained, going through the CMT certification, going on to my level 3, assuming that I passed my level 2 a week and a half, 2 weeks ago. So none of this stuff I created. I just grabbed a bunch of stuff that made sense statistically, put it together into a system, and we've been able to trade it rather profitably over the course of almost the last 4 years. So let's go ahead and get into it. Tonight's webinar is going to be on our main bread and butter entry system. It's called the BRB setup, the breakout, retest, bounce. I want to go ahead and start. Obviously, we're on TradingView here, but I want to start just by illustrating a very simple concept of how it looks, something that I tweeted out. It's just, I think, easier to see on the tweet. Inside the tweet, it says, stop buying breakouts on high volume, buy the retest instead. Better risk to reward, tighter stops, cheaper contracts. Hint, hint for you options traders. Studies show high volume breakouts run a 66% chance of a pullback. This is what we're looking at. So if you're coming from Potter's group, or if you know anything about high volume breakouts out of horizontal levels, this should click with you immediately. Think about the left-hand side of the trade versus the right-hand side of the trade. Even if you don't have any experience with the concept of expected value, right? It's more of a poker type of reference. If any of you guys play poker, you know EV, but trading is all about EV as well. Which trade do you think has the higher expected value out of the two? A or B? If you were to buy A or you were to buy B. Neither of them are necessarily wrong, but one of them has a higher expected value. Potentially, and what I'm going to try to prove to you, is that it's point B. Point B has the higher expected value for a multitude of reasons. I'll cliff note it here. Your stop loss is going to be a lot closer, allowing you to use the exact same price target. What happens when your stop loss is closer to your entry with the same price target? Your risk to reward is skewed more heavily in your favor. So what you'll see a lot of the times is traders will buy point A. It'll pop up. It'll come back. They'll think they bought the top. They'll stop out. And what are you trying to do? You're going to buy the stops off of traders that think, shit, I bought the fucking false breakout. Damn it, this always happens. But we're going to, as I'm about to show you, it's a key stat here that these things pull back more oftentimes than not. And you're going to be sitting there waiting for it to pull back. And you're essentially going to buy the stops of traders that don't understand the simple concept before the resummation of the primary uptrend. Okay? Yes, B. So let's dive first into the data. If you guys know anything about me, I'm very data-driven. The guys inside of TTI fucking hate most of it. But guess what? I refuse to put my money on the line if there's not some sort of data set study, something that proves that what we're trying to accomplish is actually real. And it's not just foo-foo fairy magic dust that somebody watched on a YouTube and some 18-year-old read on a forum and they want to teach you and charge you $600. Don't know this website, thepatternsite.com. Thomas Bulkowski. Highly suggest you just steal this fucking website. If you're a technical trader, this will be your best resource ever from just purely learning technical analysis. I'm not going to get into it. I've shilled his stuff before. I get paid nothing for it. Every single chart pattern, every single candlestick pattern, everything you could possibly want from a TA standpoint is categorized and has stats attached to everything. So if you're a TA trader, which most of you should be, this is like your holy grail of stats. Now, this doesn't teach you a system. So if you're from TTI, Potter, a different system, you still need that community and to understand how to put all this stuff together, especially if you have a very unique system like the Potter box. But this is going to give you an ability to set expectations. Within this website, I've gone through every single page. And I try to go through it every single week because he's updating it constantly, but there's always something that you can brush up on. What I want to focus here is the volume aspect, because this, in my mind, is the single most important thing when it comes to the BRB entry mechanism. Volume. I'm sure you can read the summary, unfortunately. I wish I blocked that out. But hypothetically, I'm sure you're trading. People always tell you high volume breakouts are the key. Everybody learns that. That's like TA 101. You need to have a high volume breakout. Low volume breakouts are bad. High volume breakouts are good. But what do the stats actually show? The stats actually show that high volume breakouts typically only propel the stock higher by just 1.8% on average. 1.8. That's it. So just right off the bat, do you need a high volume breakout to confirm an entry point? It doesn't really seem so. If we're looking at it from a broader swing trading standpoint, 1.8% is typically underneath 1 ADR. So it's really not a whole lot. There's not a whole lot of difference between a high volume and low volume breakout. But failures nearly triple after a high volume breakout. So wait, you're telling me that a high volume breakout only performs moderately better at best, but also offers the opportunity of nearly a triple the failure rate? Have you guys ever bought a high volume breakout and it just completely comes back, undercuts the entry, gets stopped out, and we're right back within a range? Well, it's because it's supposed to happen. That's how this stuff works. Failure is more than double for downward breakouts. So once again, even in a downward market on a high volume capitulation candle, if you're in TTI, you know we sell on the capitulation candle. We don't mess around. We're not Michael Burry. We don't need to catch the entire move, right? They fail. But here's the key. Price is 3 times as likely to throw back or pull back, meaning pullback if it's gapping up, breaking out. Pullback is if it's breaking down. So either way, it pulls back into the original level after an above average breakout. 3 times as likely on a high volume breakout to pull back. So if we go back really quick to the simple picture, this is the pullback within the BRB. Breakout on high volume, you're 3 times more likely to pull back before continuing the uptrend. That is the key. The stats show high volume breakouts on average between 55 and 66% of the time. From a swing trading perspective, pull back within 1 to 3 trading sessions. If you had a 55 to 65% edge in a casino, you would last exactly 1 hour before they kicked your ass out. That is an exploitable edge that you should be introducing in nearly everything that you're doing if it involves high volume breakouts. Almost to the point where we don't ever buy the original breakout, which we're going to look at in a sec. I'm going to show you how to scan for high volume breakouts so you can plan to buy the pullbacks. Isn't that way better than chasing the breakout? Scanning for the breakout, understanding that there's a statistical chance, a high statistical chance that it's going to pull back. All of a sudden the pressure's off. You don't have to fucking worry about chasing the breakout. You can set your orders either on the books or mentally at the horizontal level that it originally broke out. So Bulkowski, once again, thepatternsite.com, highly suggest if you guys have time this Christmas. This looks like it was built on the GeoCities web builder in 1998. Even got the fucking old school GIFs way back when. I'm telling you, every single chart pattern you can imagine is on here. I'll just give you one example because we're on it. A cup and handle, which is one of the most, if not the best performers. Here we go, 3 out of 39. If you guys have gone through the TA crash course in TTI, this should ring a bell. Highly suggest if you have time this holiday season, go through this stuff. It's great. Okay, so what I want to do now is I want to go to TradingView really quick, and I want to show you an example of this BRB in play, right? So something that we're currently in right now, and then I'm going to go back and show you how to scan for it, and then I want to show you why it makes sense to buy it specifically as an options trader. I've found a majority of my career has been in equities. I've been trading options now for coming up on, this will be my third year in January or February of next year. I have found that the BRB entry system works even better for options traders because of the volatility on the premium of the contract. So if you look at this very basic CrowdStrike trade, let me see if I can really quick. Give me one sec. See if I can bring up the actual trade idea. Where is it? How far ago? How far? Here we go. 2 months ago. So here's the original trade idea, and I want you just to look at the chart. This was what we were originally looking at. Does this look like a breakout across a horizontal zone? You don't have to agree with the zone. That was our zone. I'm not here to argue the zones. This was our horizontal level. Is that a breakout? Of course. And I'm about to show you how to verify that with volume. You can either use a moving average, or we have a little indicator here that we built, but it's very simple to build. I'm sure there's one that's free on TradingView as well. RVol, your relative volume. So remember, Bukowski said above 1 RVol, a high volume breakout, there is a very high statistical chance of a pullback. So that was what we were playing with when we originally drew up the CrowdStrike trade. And lo and behold, we get the pullback. So what do you think we did? We bought at the 170. And let me tell you something really quick before I get into the rest of this. This is not easy to do. It's very simple. None of this is completely mind-blowing stuff. But it's very, very hard to buy pullbacks when it feels like the world is ending, even if you have them planned. And that in of itself is one of the greatest edges you'll ever develop in the market. When you can buy something at the right level when nobody else wants it. There's a reason why it's down there. Now, it shouldn't surprise you. I did not necessarily cherry pick this decision. It's just this trade. This trade just exemplifies what it does, or the power, I suppose. Bounced almost perfectly off of the horizontal level at 170. The current trade is up nearly 50% spot. And obviously, I wouldn't be showing you this if it wasn't an absolutely huge win for us that we're still in. But the CrowdStrike trade just a few days ago, which we're still in, is over 1,000% winner. Now, I'm going to show you why in a second. But you have to be able to buy after you plan for the pullback. You have to be able to do it, or all of this is going to be moot. So you set the level that you're looking to buy the pullback, right? And you wait for it. You have to be patient. So let's talk about verifying RVol first. I don't want to get into how to identify horizontal levels. That's a different video, different concept. Most of you guys probably already get it. The 170 area was our level that we were focused on. On the actual breakout here, October 6th, there's 2 different ways that you can figure out if something is a high volume breakout or not. One way, double click your volume indicator and turn on your volume moving average. This is the simplest way to do it. Now, the look back period should generally be 20. You don't like 20, you can do whatever you want. This is on the daily time frame. So this is going to average out the last 20 days worth of volume, right? Each candlestick is 1 day. We're looking back over the last 20 and averaging it out. Simple way to do it. Did we close above the line? Did we close above the line on October 6th as we broke up and over previous resistance, now potentially turned support? Yes, we did. Another way to do it, like I said, RVol. Now, it's not going to look the same here because obviously we're way past that. But if we go back to the actual trade on Circle, you can see that it was a 2.46 RVol, meaning this specific breakout broke out with 2.46 times the average volume over the last 20 days. Very obviously a high volume breakout. That's where the planning comes in. We got the breakout. Now we want to buy the pullback. So what would you do here? You would stock the trade until it pulled back into 170. Now, I need to be 100% honest with you. Sometimes, even if we'll say 65% of the time these things pull back, that leaves a 35% chance that it doesn't. Sometimes these things do not pull back, and you don't get to own the trade until the next logical level. at least in TTI. It's part of the process. But at a 65% chance of a pullback, it's worth your time waiting, right? Okay, so let's talk through this from a risk to reward standpoint. Why does this make sense? We've already talked about an expected EV is higher on this pullback than it is on the original breakout. Let's say you bought it right at the, should we say market close? Where would be a stop on something like this if the price target's up here at 218? This is going to give you somewhere too far south of a 3-to-1 setup. We'll go back down towards 170. This is going to give you about a 3-to-1. So this is all hypothetical, but at the time, this is what we were looking at. As a matter of fact, let me pull up the trade. I'll give you the exact stop that we had on the books. We said we wanted to stop out below 160. So this was the stop originally. We were buying the 170 breakout. We were stopping out at 160, and the first price target was $218. Price target of 160 was right underneath this consolidation fractal. If you know anything about TA, closes below this. Do you really want to hold it if you're playing a breakout? Probably not, right? That doesn't make any sense. So this was the original trade. It pops up. Nobody grabbed it. Obviously, we're waiting for a pullback. If nobody grabbed it on the original breakout, does it still make sense on a pullback to have the same stop? Hypothetical. Some of you might say yes, but let me go ahead and tell you why maybe not. So the goal for a stop loss is to take you out of a trade idea that no longer is validated. If you bought the original breakout here and you are running a stop underneath the consolidation fractal, makes total sense. If we fall back below the entry level that we're looking to get long and we're back within the range or below it, we don't want it anymore. It's a failed breakout. So a 5-to-1 setup. That's fine. But let's say we already broke out and we're pulling back into the level that we originally wanted to buy. Would we still be playing the same stop below the consolidation fractal? Or would we look at this and go, it's not worth owning this if it doesn't bounce within $1 or $2 below 170, because at that point we're very obviously coming back within the range. So we can consolidate the stop a little bit more and skew the risk to reward in our favor even higher. It's the same entry. It's the same take profit, but it's the difference in time that changes the way you manage this trade. At the beginning, the 160 area made sense. But as we're pulling back, if it falls below that 170 area significantly, even $4, $5, we want out. It's very obviously a fake breakout. We don't want it. It's not going to bounce anymore. So we can tighten the stop, keep the entry the same, keep the take profit the same. This goes from a 5-to-1 setup to something like, and I'm not kidding, like a 12, 13, 14, 15-to-1 setup. It's the same fucking trade at the different times that changes the stop. The expectation that you would bounce here allows you to tighten the stop. That's why this specific setup is so heavily favored for people that can be patient. Now, let me ask you another thing. From an option standpoint, I can prove it to you from a risk to reward standpoint in shares. Let's talk about an option standpoint really quick. And I don't have a perfect example yet on the chain because, well, I'm not prepared, unfortunately. But I want to show you something really quick. Maybe we should just go back to TradingView for a sec. What happens when you buy on an up day as a swing trader? If you're trading options, are you buying into the premium or is premium coming down? You're going to be buying as premium is going up, right? That's why typically as a swing trader, when things gap, it's a great opportunity to at least put it on the watch list. We love gaps. It means obviously there's a lot of bullish sentiment in the stock. But do you want to buy the day of the gap up? When the contract was just maybe 100% less than what it was today, we gapped up huge on the individual stocks, so the contracts are up 100% right off the gate. That is a huge disadvantage if you're chasing that specifically as an options trader because, wow, that's a lot of premium. You're paying on top of what the guy before you paid. So if a stock is gapping up or breaking out on high volume, it's reasonable to assume that implied volatility is going up. And if implied volatility is going up and you're getting the positive breakout, those are two positive forces on premium that catapults premium sky high. That's great if you're in the trade, but if you're waiting, it's not great to buy. What happens when stocks fall to options contracts, the premiums? Let's say this, for all shits and gigs, you bought this for $1, up here it's $2.50. What happens when it pulls back? Is it a direct 1-to-1? Is it back to $1 here? Everybody here has probably had some options experience. Is that still $1? It's probably less. Probably less than $1. Generally, IV contraction is going to kick in just a little bit. The guys that originally bought the play are now going to be red on the play, even though it's right back at the entry point that they had, because LOL, options are not a one-to-one correlation to stock price on the chart. That's what makes this stuff a little bit more challenging, specifically psychologically. And now you, the motherfucker that's waiting for the pullback because you expected it, what are you able to grab? The same setup as the guy that bought at point A that maybe paid $1, but now you're paying what? Probably less than $1. And you're for sure not paying $150 to $250. You're paying less than $1 probably. So what is that going to be able to allow you to do if the price target is the same? Guy paid $1 here. They got up to about $3. You're now buying them for 95, 90 cents, something like that. Now all of a sudden you're risking less capital for the same trade idea as this guy, but you have the same price target. Does that or does that not skew your risk to reward more in your favor? It's a cheaper entry on the exact same trade idea. It's a cheaper entry on the exact same trade idea. It's fucking incredible. It's almost like a cheat code. And the best part, and you shouldn't feel bad about this, George Soros is a motherfucker, but George Soros is one of the best investors of our generation. And he's a fucking psycho. You got to think of it a little bit like a psycho. You're buying the guys that bought here. They're selling here because they're like, fuck, I bought a fake breakout. I'm now red on the position after being up. Happens all the time. And you're the asshole like, sell me the contracts, man. I'll take them off your hands. You have the same idea as this guy, but your stop's a little tighter. Take profits the same. You can get more contracts if you want. But remember, the biggest edge in my mind for options trading, if you're a directionally biased trader, is that your risk is clearly defined from the moment you enter the trade. I think that is. So if you're willing to lose $200 on a trade, the most you should put into that trade is $200. Doesn't mean you have to lose it. You can stop out early. But the risk premium that you paid is your inherent stop loss. It's the best fucking thing I've ever found in terms of options trading, because equities aren't that way. We have a stop loss, and what happens if we gap below the stop loss? We're fucked. From an options standpoint, you can only lose exactly what you put up. It's one of the greatest hacks for options trading. It's absolutely insane. Right? Exactly. Yes. So this BRB concept allows you to grab the exact same setup as the guy that bought the actual breakout, but with a cheaper contract. And that's how you get these massive wins that you see sometimes. Well, right now we're posting a lot of them because we've got most of the last 6 to 7 weeks, but we buy almost everything exclusively off this concept of a pullback. Let me show you another one that I just got into, to be determined if it works. But here's one. Hood. We wanted to wait for it to break above 1225. We got the break above 1225 right here. High volume. Absolutely. What happened yesterday? We pulled back. What did we try to do? We were patient, looking for a 1225 pullback, didn't get it. So we were trying to buy near low of day, which happened to be near market close. And so what did we do? We added in. Some guys front ran it down here because they're fucking cowboys in TTI. I did not. I bought the original position above 1225 and then added in on the pullback. It's all about adding in or starting a position on a pullback. You get more bang for your buck. The guys, that originally bought Hood here paid more than I paid the very next day on a drawdown, and price is nearly the exact same spot. Buy on down days if you're going long. Conversely, if you're looking to short, it's never a bad idea to wait for the breakdown and the bounce and open your shorts here with the expectation that we're going to continue back down, right? It's just basic TA 101. Flipping a support into a resistance. In this case, we're flipping a resistance into a support. Another one that we're in right now. Now, this one is a little crazy. A lot of you guys that are watching this are in this same trade with us, but I'm going to show you exactly how we managed it inside of TTI, because obviously we put the first trade idea that we had out above this 56.5 area, ended up being a fantastic trade. We were all able to get it free 4 or 5 days later, moved really well, and then we consolidated. We added in. So let me show you something really quick. Try to show proof here so it's not just me preaching to you guys or whatever, but we have a lot of ARM. This particular trade, Mike posted. Mike, obviously one of the longer-term members in TTI, up 705% yesterday. Most of the guys in the group are up anywhere between 500 and 1,000%. Some of you guys are up 500,000%. I'm not cherry-picking this trade because it's up big. I'm cherry picking this trade because it's a perfect example of a BRB. What did we do here? Breakout just at one RVol, pull back in towards the overhead level. It's the same idea. Doesn't happen all the time, but it happened great here, and we utilized this pullback to get more long in ARM. Then we enter consolidation fractal. Do you think we bought at the breakout, or do you think we bought on the pullback? Bought on the pullback, right? Talked about it. I think I tweeted it actually, that we were adding more at the bottom of the support range. Makes sense, because what happens if we break the support range? We can get out at a minor loss. We're either holding the range and continuing to break in the direction of the underlying trend, or we're out for a minor loss. So we loaded a second tranche at the bottom of the support. In hindsight, that was great. At the time, it was, it was a little, it was kind of hard, not going to lie. You never like to hold a contract through consolidation like this, especially even if it's a free trade, it's still hard. So we bought more down here. And then what happens when we break above previous resistance turn support on high volume? Confirm the high volume. This is a range that's set over the course of like 2 weeks. Get the pullback. People added in on the pullback. We're now in our third tranche of ARM positions. All three of them are free. And we have all the way from January, which is, they're expiring relatively soon, all the way out to March. And some people have Aprils and further out. Is this a cup and handle? This would not be a cup and handle. A cup and handle is going to be a rounded bottom followed by some sort of bull flag. This would not be a cup and handle. But remember, this is a different video or a different topic for a different video. Chart patterns just offer you an opportunity to set risk to reward. That's it. If you're, not you in particular, but if people are obsessed with identifying shit like this and scanning for it, you're going to have a really hard time if that's the only thing you're doing. Because I'll tell you right now, last week, there was 900,000 symmetrical triangles that you could probably buy. You have to have a process to figure out which symmetrical triangle makes the most sense, which is why we don't do that shit in TTI. Chart patterns give us an opportunity to define risk. In this case, it was bottom of the support range, cut on any drop below. And then when we bought back, obviously the stop was at the original 62.5. Chart patterns are great for defining risk, but as for just scanning and trading those, not so great. So let's go into really quick how to scan for this stuff. Steal my scan, I don't give a shit. We're going to go to the 50-day high scan. We're going to take out ETFs. 56 names on this scan right now. I'm assuming one of them is probably going to be able to give us a BRB. I have not done this yet. We're doing this live, so I have no idea what we're about to look for. But I want to talk through the requirements first really quick. 50-day highs or some sort of high is a requirement. You're going to want some sort of new high. 20-day high if we're really coming out of some sort of corrective phase or bear market. 50-day high is our bread and butter. 52-week high is you're looking at yearly highs, right? That's very powerful. Average volume, you can mess with this a little bit. We like to use over 1 million because generally speaking, things that are over 1 million are going to also have liquidity on the chain. As a swing trader, we don't have the luxury of having weeklies or 0 DTE liquidity. Weeklies and stuff like that, and even the very first month out, generally are loaded with liquidity. As a swing trader, specifically TTI, we're looking 60, 90, 120 days out. We have to be a little bit more selective because there might be a great play based off of the charts, but there might be zero open interest and zero volume on the contracts we want, and at that point, we don't want to play ball. That's a bad situation to be in. We don't want RSI below 50, right? Now, I'm not going to tell you why. Just, we don't. We only want to buy when RSI is above the 50. Optionable and shortable. Obviously, you have to make sure that it has an options chain. But here's that relative volume idea once again. So it's imperative if you're looking for breakouts, you want to have one RVol or some sort of relative volume variable selected because you don't want to be scanning for things that are breaking out on low volume. Because why? It's not that it's a bad breakout. You can go buy the low volume breakouts, but the stats show that there's probably not going to be a high correlation to a pullback. And the whole idea here is we want to buy high quality breakouts on pullbacks so we get better entries. That's the whole point. We can define our risk, tighten it up, get huge risk to reward on top of it. So here it is, the one RVol. We're going to go through this together. No idea what we're going to find here. Let's go out to the weekly really quick. What we look for in particular, actually we'll go on the daily. Horizontal level breaks. I mean, that's realistically it. The problem right now with the market is we're up so big right now that it can be very challenging to actually go and find them. GTX might be one. Yes, so this is this is an opportunity for a BRB. I don't love this trade setup, so don't go and buy this tomorrow. But what you can do from like a scientific point of view is see if this thing pulls back tomorrow and towards an overhead supply zone. So draw any sort of level, bring it up. Doesn't have to be perfect. Something like this. It's a range, right? We've been sitting in this range for almost 2 years straight. We're breaking up for the first time. This is a 3-year high going back to February of 2020 on high volume. R vol is above 1.57. R vol is above the moving average. Both of those telling us the same thing, by the way. If you don't want to look at R vol, just open up your moving average. Once again, just double-click your volume histogram and enable it. So what would you expect here on GTX? You would expect a pullback within the next 1 to 3 trading sessions back towards this probably 850, 860 area. And it doesn't seem like a huge difference until you shift-click down. It's a 4-5% difference in share price, which is not negligible. That's decent. This is a little bit lower volatility, so I don't know if this thing is actually going to pull back all the way. That's, once again, a topic for a different video, so I don't want to get into that. But what I will do really quick is, 1 second. Let's go over to the chain really quick and just see. I really doubt there's going to be any volume. This is an elephant print. Any of you guys know what an elephant print is? One dedicated buyer. Show you a little cheat code here. We can see it is. It's one buyer. They bought him at 1 o'clock yesterday. So somebody is very directionally bullish on GTX. Somebody went out and bought 1,363 contracts at 1 p.m. for 40 cents. A little detective work for you. If you don't know how to do that, I just unlocked a cheat code for you. But we can see there's a little bit of volume. So let's pretend we want to own this. Once again, this is not a trading suggestion. I'm not buying this. We would expect, let's draw some sort of Fibonacci levels to get a decent price target here. Fibs aren't magic, but they generally put you in the right vicinity of previous support resistance where other technical traders are looking to take profits. Not a bad place to think about taking some as well, or at least moving stops up. So we're looking at like a $10, $50, $11 price target. We'll go back to Tasty and the $10. We're generally looking for the 0.25 delta. $10 has 43 open interest with 65 volume. I don't love it. But once again, I just want to point something out here. If I right-click on this $10 contract, what do you think the price was yesterday prior to the breakout? So this is a high-volume breakout. Yesterday we closed, this might be a terrible example, but we'll see. Yesterday we closed at 834, and today we closed at 892. So obviously up 695, 6.95%. What do you think the contracts did? They went up in value, right? So if we actually go and look at that, week to date, looks like we have one buyer. Let's go to the 10-minute chart. 65. All right, good enough. Bought them today. Just one guy, huh? One asshole. No, there's two assholes. Look at that. Somebody bought two first. Somebody bought them for 30 cents. Somebody bought them for about 34 cents. And right now they're going for 35 to 40, depending on where we open up at tomorrow. If this thing pulls back, do you think they're still going to be going for 35? No. You're going to get them on a discount. So the guy that bought these today for 30 to 35 cents, if this thing pulls back tomorrow, you have a decent opportunity at grabbing these at 30 or maybe even 25 cents. I'm not saying you can, but that's the type of stuff you're looking for. So if you know one guy on here bought them for 30 to 35 cents and you're able to get them for 25 to 30 cents, you have an edge over this specific trader, right? 20, I think, is probably going a little bit further out there, but man, that'd be nice, right? If you could grab something like that for half off. I don't know if we're going to get that. One thing I don't want to go into in this webinar, but ADR here shows that this is not a really fast mover. And so generally we're not going to get a huge move back down. And so that's going to open up or not open up the possibility of a 50% discount on contracts. The higher ADR names do. This one in particular at under 3 is just going to be a little bit slower of a mover in of itself. But we can see the contract premium popped with the premium or with the breakout today, and we would expect a pullback is also going to cause the contract's price to pull back as well. So what would we expect this to do? We expect to pull it back to somewhere around 860, 850, and then continue to bounce up towards the price target. If you're able to grab these for 5 cents cheaper than the guy that bought him here, you have an edge over him, and you're maximizing your risk to reward. That 5 cent difference on those cheap contracts adds up a lot, especially if you get in the money, by the way. I'm sure some of you guys know. You've been in some big trades before where you grabbed it at $1 and somebody else grabbed it at $1.15. You're both in the money. How much quicker does that dollar contract in the money blow up in premium, right? So that 5-cent difference in a cheap contract matters a lot. So there's one. GTX, once again, not a trading suggestion. I'm not taking that. I don't like the sector, industry, or why can't I see the next page? Sorry. It's going to look like crap for a second. I have this problem where the taskbar sometimes hides the bottom of the browser. All right, we'll keep going. Just bear with me here. We'll keep going. I don't remember if Kava was a good example, but this was a name that we were stalking for a BRB setup. Let's go ahead and look. You can see the trade idea on the books that we were looking at here with Kava. Yeah, it was. So this is a name that we wanted to get long, but we didn't because you can't buy everything, unfortunately. This is our big blue sky breakout setup, but this is the BRB in play. We got the break above the horizontal level that we wanted on high volume. We got the pullback the very next day in towards the level. Once again, we didn't take this as a group because there's too much shit going on right now. You can't buy everything. Good example of this is perfect. This is bread and butter, right? So we're looking at potentially buying back towards the 8. And as a matter of fact, when we were coming up with this, that was the entry. So we almost sniped the absolute bottom. But once again, you're maximizing your risk reward on buying the pullback instead of buying the breakout and potentially having a fake out, right? So Kava, good example there of the BRB. And yeah, it was on our watch list too, but you can't buy everything, unfortunately. I wish we could. CPRX. I don't think this is going to be one. Maybe CVS. Except CVS. We don't want to be buying these low volatility stocks right now, guys. We don't want to be buying these low volatility stocks right now. Trade setup that we had on here, I wouldn't consider this a BRB, just more so of a low volume breakout. Let's go back. ESPR. That's a name that actually we do have a couple guys inside of TTI. Not a BRB. Decent trade so far. Not a BRB though. Here's a name right now that you guys can look. And if you guys are a little bit more risky, this is our BRB setup, excuse me, our big blue sky setup that we initiated on today. So this is some sort of fucking footwear company. I have no idea what it is. But this is an all-time high breakout in a recent IPO. We buy these things all the time. Most of them work well. Hint, hint, ARM. Right? Stuff like this. VSTS. Any reason why I don't want to buy volatility stocks? Yeah, I'll give you 3 reasons. IWM above range high. High beta stocks are not, or excuse me, low volatility stocks are not living in IWM. So high beta stocks. ARC is breaking out. High beta stocks. IPO is breaking out. High beta stocks. You don't want to own low volatility stocks here. SPHB, S&P 500 high beta, breaking out. SPLV, excuse me. S&P 500 low volatility, not breaking out. SPHB against SPLV. Which way is the line going? Is it up or down? If it's up, high beta stocks are outperforming low volatility stocks. There you go. There's a quick little run through on why you don't want to own low volatility stocks right now. The market is rewarding high beta stocks. And as a trader, that's a good thing. You make more money. Let's go back to VSTS really quick. Breakout. Man, I hate how this thing like magnets. Breakout. High volume. Pullback. Bounce. And we initiated on it today. So once again, good example. BRB. Now I could do this. What's the screener you're using? It's not personal. You can steal it. I don't care. It's FinViz. I'll scroll up slightly so you can see it. So I've gone through like 3-4 different examples. Some of them we're currently in. Some of them we're looking at getting in. This VSTS that I just went through is a good example. Excuse me, I'll show it again as soon as you guys have a brief second to look at that scanner setting. These setups happen all of the time. And the key here is that volume. You have to make sure that it's a higher volume breakout. So if you're scanning for something like this, relative volume over 1, maybe scan for higher beta, which is available on the scanner as well, right? Beta is volatility. A beta of 1 is going to be the same volatility as the S&P 500. You can mess around with that. Obviously, if it's a high beta type of environment, maybe more than one is beneficial, right? Mess with this. Figure out how you can spot these types of setups. VSTS is a great example. We'll see what happens tomorrow if this continues to break out. ARM was a great example. Hood might be a great example. Meta, a great example. The BRB everywhere. We've entered Meta 3 times this year. All 3 of them have been big trades for us. BRBs everywhere. Look for the high volume breakouts and then time the pullbacks. This is the original trade idea we had on Okta, but we never entered it. Just extend the level over. I mean, the level is the level for a reason. Above $90, you got to be more bullish than bearish on Okta. Below 90, you don't want it. This was the trade idea going back all year. We never bought Okta because it never cleared the 90 level, but yeah, it's there. Steal this. I don't give a shit. Run this. I have no problem with people stealing any of my stuff. I put so much of it out for free. Don't care. Because eventually it's going to either click for you or you're going to pay me so you get to hear me rant in your ear all day, every day until it clicks. Doesn't matter to me either way. Okay. Are there any questions regarding the BRB entry specifically? I encourage you guys to go out and scan for this, or at the very minimum, keep it in the back of your mind that high volume breakouts on average pull back. And so if there's a stock you really want and it breaks out on high volume, don't sit there and think to yourself, shit, I missed it. Think to yourself as, I'm going to buy the same contract or shares as some other asshole, but they're going to be dumping them to me thinking that the position is over for a loss and I'm going to be able to make some money off of them. That's all it is. You're taking naive traders' stops and using them to your advantage. All right? Any questions regarding any of this stuff as I scroll through really quick to see? Sentinel-1, another trade out. You can see that the trade idea there. This is, look, great example. I completely forgot about this. Trade that we're in contracts and shares. The original trade at $23. Let me show you. Type up questions if you have any while I show you this really quick because it's a good little example here. Trade ideas. I don't remember if Sentinel-1 was posted or not. I'm going to look like an asshole if it's not. It was. Look at me. Here's the setup. Remember I told you gaps aren't bad. We love gaps because we're not the assholes buying them. We know, though, that if something gaps up, it's a change of sentiment on the individual stock, and it's on our radar. Now it's just what price point do we own it? We wanted to own it above 23 with a stop out at 21.25. Look at this. Own it above 23 with a stop out at, what did we say? 21.25. So look at this. If we bought it at 22.5, but if we bought it above 23 and the stop was the original 21.25, I want you to look at the risk to reward. Still a good trade, don't get me wrong. 3.5, 3.6. Look at this. Not a bad trade. A 3-to-1 setup like this or a little bit more is a 25% break-even win rate, meaning you could lose 75% of your trades over a large sample size and still be break-even if you're nailing these. So a lot of wiggle room to be a really shitty trader like myself. But instead of buying the 23, we bought the pullback at 22.5 the very next day. And what do you think we did? We tightened the stop up to low of day. 21.85. That just went from a 3.5 to a fucking 10.7. If you guys aren't understanding how we can keep the same take profit, tighten the stop, and mess with the entry on the pullback to maximize risk to reward, if this thing came back down and broke back below, we're back within the range and we don't want to own it. This is right back into the stage 1 accumulation zone. This went from a 3.5 to a 10.7. Can you imagine what the contracts did? Right? Hopefully this is clicking. This is a huge trade. We have a lot of guys in this one. It's been out for, I think, 2 weeks. We've owned this thing. This, like I said, though, there's so many of these. Here's another one on a weekly. I'm the last asshole standing in this, but look at this. I'm up 700% in the UBS play right now. This is a weekly chart. Weekly. I bought a 15-year breakout because I'm fucking an asshole. I bought it way back here. Got the pullback up into new highs. Contract's up 700%. It expires in like 19 days. I've held it for, I think, since July. Telling you, though, this basic concept matters. I'll answer a few questions and then I got to hop off because you know what? It's Christmas week. SPR looks good. This is not something we would buy. This is not. I should bring it back down to the daily, but yeah, not something that we would buy. It's not advice for you, but this particular setup is not for me. It does have a nice ADR for an aerospace and defense name, but let me show you something really quick. I don't remember the damn ETF now. Which one did we use? ITA. We have all-time highs in aerospace and defense, and the name that you just pointed out is coming off of like a 52-week low. Inside of TTI, that would be a no-go for the trade. We would be looking to buy something near or at all-time highs. If the ETF itself, the industry itself, is at all-time highs, we want to own the stocks that are pushing that ETF into all-time highs. It's a different video, but sector strength, right? That's the most important thing inside of what we do. So SPR is not for us. OKTA is looking for a short at the resistance. Yeah, you do. That's not what we do either, but feel free. Above 90, we want to be long. Best book of PDF of a site. Nobody reads books, man. I'll be honest with you. Everybody always asks me. Nobody fucking reads them. This website, go through it at your own leisure. ThepatternSite.com. It looks like shit, but if you really want to learn, I've never found... This is the holy grail of technical analysis. Like I said, studies, chart patterns, index, high and tight flags, which are everywhere in the market right now. That arm play, hello, right? Don't got to reinvent the wheel. Has all the stats on it. Just go through it. Uber for a short. We're long Uber. We've been long Uber since right here. These contracts are up like 500% for us, and it's pushing into an all-time high. If you want to short this, be my guest. We're looking to re-enter long at 64 into an all-time high break, targeting 95. But this has been an incredibly fruitful trade for us, Uber. This is a BRB as well, by the way. Ironic, but I don't think we entered that off of. I'm new. Could you elaborate on how the BRB? Nope. You can watch the recording. I apologize. First five minutes goes through it. Yeah. So one thing I will tell you, that's a great point. All of this stuff, what Bukowski quantifies, this specific website, is from a swing trading perspective. So he's looking at daily or weekly data sets. Make sure you take that into consideration. But I do have to say, technical trading is fractal in nature, meaning it's repeatable across every time frame. Right? You're going to have symmetrical triangles on the daily, weekly, yearly, monthly, 1 minute, 5 minute, 3 minute, 30 second. Fractal in nature. They're going to show up on every time frame. So I don't have the exact stats for a day trader on a pullback, but is it reasonable to assume that it's probably somewhat similar? Yeah, I mean, I would still be looking for pullbacks on, for example, open range breakout highs. I'm not going to pull it up right now, but like an orb play on an index, something like that. Look for a breakout and then a pullback into a VWAP, which would essentially be a BRB before another bounce. We're in Braze, but it's a slow-moving trade. We're able to get out at free contracts on Braze, but the guys in shares we're up on this, but this looks like it's going to be a stinker. We never got the push through. So this is a trade that we're in. We bought it off of the 50 pivot. Contracts were free up and over 100%. So we're able to hold this thing risk-free, right? No principal in it. For the shares guys that are in this off the 50, they're up like $3 per share. This is, in my mind, this is a failing trade. It's still profitable. We'll see what happens. I'm not showing it. Whoops. There's the trade on Braze. We're in it, but we're not expecting too much. SE, yeah, this is, you can see we were looking to buy this thing like 2 years ago above 71. It never got there. So we don't buy shit like this. We don't buy BABA. We don't buy these Chinese names that are just absolutely getting crushed. Only two names in that space that we want to eventually own is PDD. You can see the trade idea there. And EDU. 2 entry points that we took, but we don't own it anymore. We don't want to own anything in that space because it's just not working. 98% research, then 2 clicks. Dude, this website is fucking phenomenal. I'm telling you. Go to this website. You got some time this weekend or the next few weeks as the holidays obviously give us a little bit more extra time from work. You can sneak away from your kids and wife, family, just read through 30 minutes a day. Just randomly click on stuff that interests you. There's really there's no tutorial on this website, but my favorite part is the studies tab. You can come here. You can see I click on this stuff all the time and the kind of like refresh. You can see what I'm looking at here. But look at this. I mean, you could spend months on this website and learn something new every single day. It's incredible. For your fibs, do you go to all-time low? No, fibs are specifically used on some sort of range. It can be an all-time high like Uber. I think we used it because we were buying within the range and expecting an all-time high, so we wanted to see where exactly mathematically it made sense to move stop-ups. That's all we use fibs for, by the way, if anybody... Some people like to buy retracements at golden pockets and all this shit. We just use fibs for math. That's it. That's all it is. It's just a way to develop risk. If you buy the one, you stop at the 786 and you sell at the 1.6 or 1.618, it's going to be a 2.8 or a 2.9 setup every single time. So if you're going for a 3 or 4 setup, you can you can move your stop up a little bit. It's just a way to mathematically develop a very quick risk model. We don't think that fibs really do anything. Now, do they? I don't know. I don't have the stats to prove it, but I don't think it's a coincidence that fib extensions tend to match up with previous periods of consolidation, but I'm not there to argue that. So, okay, I'm going to get off. It's been an hour. I appreciate you guys. If you have any questions, feel free. I'm going to go ahead and show my Twitter really quick, just because I'm active on Twitter more so than anything. Where's Twitter? At How to Swing Trade. I respond to DMs. Obviously, I post a lot of stuff on my Twitter all day. Somewhat, at least. Feel free to interact with the content there, right? I post trade ideas and stuff. If you have any questions regarding the BRB video in particular, you can obviously leave them here. It's better to reach out to me on Twitter than it is on YouTube. I just get spammed by like fucking third world idiots trying to promote my shit and get me to send them Bitcoin. So if you want to talk to me, just leave comments on the actual video here on Twitter, and I'll be able to get back to you, okay? What was the stock's name used in the website, Polkowski? Where was the stock's name?